My guest on the show today has predicted many bull and bear markets right. Shankar Sharma of First Global. Shankar, hi, welcome to ET. Thank you for joining us. Shankar, currently all asset prices are witnessing what could be called as a synchronized sell-off. Do you think the risk-off trade is here to stay?
Yeah, I think because see, all the asset classes like real estate or commodities and equities, they are completely correlated. I mean, usually they will go up together, by and large. The only thing that is not correlated is U.S. Treasuries. So the only one that has actually done reasonably well in this whole sell-off in the last few weeks is basically the U.S. bonds, the government bonds, especially the 10 years. So it is pretty much in character that whenever you have aversion to risk or some event like Greece or whatever, and these things keep happening, then you have a pretty coordinated sell-off, which is what we are witnessing.
Beginning of the year, Shankar, on this forum last time when we interacted, your call was to sell emerging markets and to buy developed markets. Would you like to revisit that call?
Nothing is worth revisiting just yet. I think this year is going to be a very, very tough year for EMs. That the signs of that started by late last year and they have continued well into this year. And I see nothing that will change the trade just yet. Because I don't see even in EMs where the big sort of growth numbers will come through, which will surprise us enough for the markets to do better than what they have done. If anything, there can be disappointment. And India is a good case in point wherein numbers have been tepid. So in order to sustain the market at these levels, you needed numbers which had to be substantially ahead. But that's being in a fool's paradise. That was not going to happen, and it did not happen.
Right. If I look at the YTD performance, Shankar, for Indian markets this year have underperformed other EMs and other developed markets. Second half, do you think Indian markets to underperform further?
I would think so. I mean, India is very correlated to the world, to EMs in particular, and we rarely have kind of stood out one way or another, except for very brief periods of time. For instance, when the LIC housing thing happened last year, we started to correct well ahead of other EMs because that was an event-related issue. But by and large, we are pretty well correlated with the rest of the global equities markets. And when you see weakness there, India being a relatively higher beta market, India also tends to perform in tandem, if not a bit worse than the rest. So I think given the outlook on EMs, which is reasonably soft, I think India will continue to lag.
Do you think the rampant speculation in commodities is over?
About time too, because I always believed that a boom in commodities is completely irrational because it always benefits just a handful of people and it impoverishes most of society. So that kind of a lopsided boom cannot last forever, unlike a stock market boom, which generally sort of enriches everybody and doesn't impoverish too many except the big bears. So if you were to be fair on the side of commodities, it is exactly the opposite. So I have always believed that commodities bull markets can't last. I mean, by one way or another, either by government action or by simple laws of demand and supply that people will have to necessarily cut back, commodity bull markets have to get punctured.
Would you advise our viewers to go short on commodities even after the recent correction?
Oil definitely looks like a short. The other ones, we'll wait a while, but oil definitely is a short.
Why do you say that?
Oil had no reason to go up in the first place. The demand supply numbers didn't ever justify where it went in the middle. It happened because of again event issues around the West Asian problem. That kind of has settled down, so therefore that risk premium is now being evaporated from the price of oil. And if you're looking at a generally soft situation for big consumers like India and for China, who are at the margin, not in absolute terms, but at the margin, the growth drivers, then the demand supply picture also doesn't look very encouraging.
Do Indian markets actually enjoy a negative correlation with oil? Because if I look at 2003, 2007, 2010, every time oil prices have gone up, Indian equities also have rallied.
Which has always been my point, that it is a big myth to say that oil comes off and India will rally. That's all stuff that only economists can keep talking about. For us market people, we understand that they are pretty much unilateral. They go up together and they come down together. Because both are highly risk-oriented trades. When the world wants risk, it goes and buys EMs and it goes and buys stuff like oil. and India is very integral to the whole EM pack. So we are very positively correlated to oil.
So if oil comes down, you will not turn bullish on Indian equities.
I don't think the two things necessarily follow each other.
You see 15,000 acting as a serious base for the Sensex?
Well, I mean, looking at the way it is going, it's not about the 15,000. It's more about the the grinding nature of this market. That is the real issue here. If it were to correct and correct fast, then it would be a different ball game, because then you would have opportunities spring up very quickly. But this market is not going to go down that quickly. That much it has displayed in the last year and a half, that it is headed lower, but not headed lower the way we have seen it happen in 2000, 2001, 2007, 8. And any interim falls in the bull market also. This is a slow grinding kind of market, which doesn't make even for a great short sell trade, unfortunately.
So what is really preventing a waterfall decline from here?
I think the markets have generally kind of decided that they are not going to make any big move either way in a hurry, and it's just kind of counter to the kind of volatility we saw in the years preceding the last year and a half, when we had excessive volatility. Every year we were up 20%, down 25%, many times in a year. Now we have kind of come beyond those days, and now we are set for a market which is very narrow, very grinding, almost boring. So here you will not, at least, I mean, that's my reading so far, that this is not a market where you can place big bets and expect to make quick returns.
So which is one big asset class you would back or you would bet on for next 6 months and for next 12 months?
I have been very clear last 12 months that fixed income is the only place where you have safety of your return, and don't even bother looking at the equity markets if you're a small investor. If you're a large investor who can take a bit of risk, that's a different ball game. Small investor, no reason for him to be invested in equity markets, looking at the way they have been for the last 12, 18 months.
So you're certain that the golden period for Indian equities is over?
It's never over permanently. It is only over in phases. So it got over in 2007 December, 2008 January, because we had compounded at 55% from the lows of 2003. Those kind of returns to expect to start recurring within 1 or 2 or 3 years of a pause is just being plainly wishful in your thought processes. You're seeing that the market returns are flat over the last 3 years, in fact slightly down perhaps. So you're beginning to normalize the excessive 55% return we saw of 2003 to 2007. This will normalize over time to the normal 15-17% that we have seen our markets give over a 30-year history, which means that you will remain flat, you will fall from the lows, you will bounce back, that by and large you will not really deliver returns which are in excess of the peaks we saw in 2008.
So you don't see markets going to a new high soon?
No, I mean, I would think that's a virtual impossibility.
Yeah.